Let's put the personalities involved in the Barnes & Noble story aside for just a moment and focus on what Liberty Media brings to the table. Morningstar analyst Peter Wahlstrom says Liberty's deep pockets may be just what the book retailer needs to compete with the likes of Amazon and Apple. Peter joins us now from Chicago. Peter, good to have you. Thanks for joining us. So,
good afternoon. Thank you.
You had said that you were surprised, actually, by Liberty Media's bid. Why?
Sure. When the company started to look at strategic alternatives last August, it was really a hurry up and wait scenario, kind of radio silence, and then this coming out of the blue. We had been focused primarily on financial buyers, and when the strategic buyer in a conglomerate such as Liberty Media came up, it was something that made a lot of sense for us.
So why does this make sense? I mean, we talked a little bit about the deep pockets of Liberty Media. Is that all?
You know, number one, we feel good that the company, Liberty Media, has gone out and said that they would like to have Chairman Len Riggio's involvement and for him to keep his 30% stake. He's really viewed as a patriarch for not only the company of Barnes & Noble, but also the book-selling industry. So to have his knowledge and potentially on board with the combined company would be a plus for us. But when we do take a step back and we say that the Barnes & Noble really has been investing, obviously, in the digital platform by using cash flow generated from its bricks and mortar and from its college business, if it were to be absorbed into another conglomerate such as Liberty Media, we think that would allow the company to invest at accelerated rates and really generate returns more quickly than it otherwise would be able to do on its own.
All right, so yesterday there was a special stockholder meeting that Liberty Media held. And at that meeting, Sheila referred to some of the things that John Malone said, but he also said that he thought this deal would go through in, quote, months, if not weeks. What do you think the odds are of that happening?
You know, certainly it's difficult, and you wish you could be a fly in the wall at that point. But you know, the time frame seems reasonable. It seems like both parties are coming, and they've got a common goal, in that they'd like to see the digital platform grow, and that Barnes & Noble could return, at least in that phase of its business, into a growth company. And then there's also the commitment to the physical book-selling business, and I think that's what Len Riggio really likes as well. So it seems to be an interesting partnership.
Okay, speaking of interesting partnerships, let's talk about Ron Burkle and Leonard Riggio. Now, Burkle made an interesting move yesterday. He's bumping up right against the point at which he can't own any more shares. So where does he go from here? Do you think he likes this deal? Does he partner with someone else to put in a better bid?
It's a good question, certainly, as he is bumping up against 20%, and he's still, as we understand it, to be underwater with his initial average cost, which is kind of in the low 20 range. So he'd like to see the price go up, certainly, so he can recoup some of his investment. But I think from a longer-term perspective, it also does. It is a measure of support and kind of a vote of confidence for Liberty Media and what they're trying to do and the emphasis that they're placing on the digital business. And maybe that's Ron Burkle's way of getting a little bit more attention on his own and saying, hey, there could be some additional value above $17, above $19. The way that we had taken a look at it, in our view, we think 17 to low 20s is a reasonable takeout valuation range for Barnes & Noble, which does consider a fair amount of growth for the digital business.
And you also think, let me get this right, you'd be a seller if it hits $32. Seems like we're a long way from that point in time.
Yes, exactly. That would be, so our fair value estimate is $16. So we would encourage individuals, investors, to take a close look at any sort of proposed transaction above that level. And in a more bullish scenario where you do have extended growth, not only the top line for digital, but stabilization in the physical book-selling business, and maybe Barnes & Noble takes some share from Borders as they start to close stores. And then ultimately Barnes & Noble becoming a little bit more profitable, not only on the digital side, but then on the physical book-selling side. We do think that there's upside to our base case, but yeah, you'd be hard-pressed to maybe get to $32 in the next year or so.
Peter, fast forward 5 years from now, maybe even 10 years from now, what does Barnes & Noble look like? What does bookstores look like? Do we have bricks and mortar stores?
I think the short answer on the bricks and mortar bookstore is that yes, there will be physical bookstores, but I don't think that we're going to have the same number that we do today, with Borders obviously closing roughly 200, 250 of its stores, and Barnes & Noble, on the other hand, having much more of a commitment to its physical bookstores. They are profitable at an EBITDA and an operating income level, albeit low single digits, and they've talked about maybe closing net 5 or 10 stores per year. So on a 700 base today, you know, you could see down the road where the combined entity of Barnes & Noble, excluding its college bookseller business, could be in the 600 store range. But there is a dedicated reader that likes to hold a physical book. We think that there's a market for the consumer to go to a physical store to not only buy stores, but to buy books. But there's the cafe, there's the educational toys and games that Barnes & Noble has been really making a push towards. The digital side is still very early in our view.
All right, Peter, we got to end it there, but thanks so much. Do appreciate the insight.